Namaste. My name is Kaushik. Today's episode is based on a blog which has recently come in DSP Mutual Fund. Very interesting blog where the headline says why investor returns are not equal to market returns. Before we proceed, we are Tanashri Fintech Private Limited. These are our contact numbers. I am Kaushik Ghosh. Okay, so expectations. So whenever we invest in the market in mutual funds, we always hear that Nifty has delivered so and so percentage over the long term, CAGR. So naturally, what happens is, although our disclaimer, our industry disclaimer is past performance is not the guarantee of future returns, but obviously, when all of us keep hearing over and over again, we somewhere at the back of our mind we assume that, yeah, I mean, I should be getting that kind of return. Of course, it's a problem when people assume that investing in equity is like investing in an FD with a higher return. Equity is not like that. The problem with this expectation is that the long-term average belongs to the past. And remember, it's the average, which means that there are many people who make lesser, there are many who make more than this average return. And frankly, each investor gets a return based on the journey. It's not the average. For a simple reason, let's say an investor entered the market for the first time in September of 2024. Market was at an all-time high. From 2024 till now, which is what, 1.5 years, almost 2 years now, almost 2 years, uh, the market has not given any return. In fact, it has given negative return. So an investor who has just entered the market about a little less than 2 years back is seeing no return. He says, I should have invested everything in an FD. And that's where many investors exit the market, book losses, exit the market, and revert back to FDs. That's what happens. And that is why it is said that investor outcome depends on the journey, not the average. Okay, so the problem with the 12% CAGR is it's a historical return. It's a number which has happened. It's basically a description of what has happened. It's obviously not a guarantee, which we keep on repeating our disclaimers, our industry disclaimer actually. It's not a promise and definitely it's not an entitlement. It does not say that if you invest in equity in Nifty, you are bound to get 12% return. No, it's not that. This 12% return is a 20-year CAGR. So will you be invested for next 20 years through thick and thin? That's the basic question. And we don't even know in the next 20 years whether we'll get 12%. Maybe we get 50%. Maybe we get 10%. We don't know. So all of us make this mistake, investors especially. Uh, we look at history, we build an expectation, and then we think this is what we should get. The problem is that historical data points are not promises. And like I already said, the Nifty returns will vary significantly with start date, with end date, what kind of index you are investing in, whether you are investing in Nifty 50 or Nifty 500 or small cap, mid cap, whatever it is. Okay. And also reinvested assumptions, which means that you book profits, whether you plow back that into again investment or not, all those things, right? The second problem, which is that like any average, an average is an average. It means that there are many people who don't make that return. There are many people who make that return, more than that return, more than that return. Okay. Uh, Therefore, don't expect that an average means I will get that return. No. In fact, the reality is that most investors earn far less than the average for a variety of reasons. And it's not the market's problem. It's the investors, I would not say even a problem, it's the investor's journey. So therefore, this is where the disconnect starts happening. I have invested for 2 years. I am not seeing any return. But before that, I saw previous 2 years rolling return. I have seen captured for like last 20 years. I should have got more return. All those things, right? So therefore, this is the second problem: is that an average is an average. Average is not everybody is getting that average. The problem number three is that it's path dependent. It means that your journey will determine your return. Like I again revert back to that example. You entered the market in September 2024. Almost 2 years have passed. The market has still not reached that level. Essentially, it means that you have not earned any return. Probably you are in negative. Probably, I don't know. Okay. Now, does it mean that you made the wrong decision? The answer will come in the next few slides. But no, the answer is no, you have not made the wrong decision. It is just that your expectations are incorrect. Your expectations, which has become an entitlement, saying that I should be getting this, right? Obviously, we hope we'll be getting that, and we hope we'll be getting more than that. But just saying that because I've invested in the market, I'll get 12% return is not something the market will necessarily give you. Also, remember, any investor, every investor goes through their own life journey. There may be some emergency at home. You need to withdraw money. Okay, you need to tap into whatever corpus you have. But therefore, your investment journey stops there. Then you have to rebuild all over again. So, investor may not survive the journey. The market will continue. The market will survive. There is no problem in that. So the answer to all this is SIP. Now, obviously, there have been, you know, our industry body, AMFI, has been aggressively promoting SIPs for a long time now. म्यूचुअल फंड सही है, SIP सही है, and for good reason. SIPs work fundamentally because our investment outcomes are determined by our behavior. Our investment outcomes are not determined by how well we pick stocks or mutual funds or how good we time the market and all those things. No, our returns depend just on our behavior. The the fundamental thing about behavior is as follows. So let's take the example of uh, mastering a subject. Okay. Now let's say that subject book has 20 chapters. You need to master the entire book. There is a journey for that. It means that there are some chapters you will not be very good at, some concepts you will not be very good at. You will have to come back and revise and take somebody's help and practice and do all that, right? Or take the example of a mango tree. You have planted a mango sapling. The first time you can expect any fruit, and even if it's a hybrid cloned mango sapling, not before 3 years. Definitely, I think not before 5 years, but okay, let's take 3 years. Let's say you get your first crop of mangoes. When the mangoes are ripe on the tree, there is unfortunately, a troop of monkeys came and obviously took most of the mangoes. What do? You have lost your crop, right? Or there is a hailstorm and the mangoes are still in the budding season. It destroys most of the flowers, right? There goes your crop. So therefore, everything is uncertainty. And our behavior, our response to uncertainty will often determine what we end up doing. So we have to ensure that we build protection against uncertainty in our investment journey. So, I mean, the basic steps are you do your risk profile, then you do asset allocation as per risk profile, then you deploy, and then you keep monitoring. That's all we have to investment. That's all we have for investment through mutual funds. Trust me. So therefore, the final message from DSP and therefore from us also, because we are also distributors for DSP, is that the problem is not SIP. I mean, we have heard there are many videos, many social media videos where people are saying, SIP will not make you money, SIP will not make you rich. The same videos don't give any example of how you will get rich by not doing SIP. They give examples of stock picking. They give examples of episodic richness, which means I have invested in this stock. I got 20% profit in 6 months. Wow, that's not wealth building. Wealth building is a journey of 20, 30 years. So therefore, the problem is not SIP. The problem is interruption, especially in today's market. Very, very valid uh, point. There are many people who have stopped their SIPs. There are many people who are saying, oh, let me put my money back into FDs. There are many people who are saying, equities don't work. I made a mistake and all those things. No, the market does not have a responsibility to give you the return. You have a responsibility for doing your risk profiling, your asset allocation, your deployment, and then staying invested. That's all to it. We hope that you find this video informative. Uh, this is our disclaimer. These are the list of mutual funds we are paneled with, and these are our contact numbers. So if you have any comments, if you want to reach out to us, please comment in the comment section below, or please WhatsApp us or call us on these numbers. Thank you. Namaste.